Okay, welcome to week 5 here on payroll. We're going to begin to put everything together, especially in part 2 of this lecture. I'll probably be ending up breaking this lecture into 2 parts. This first one, going over the material, doing some shorter couple lecture examples over the W-2s. And then part 2, looking at doing a more in-depth, just practice problem using all of the tools that we've done so far, which is the payroll register, and then using the payroll register to answer the questions into the 941, going back to the 941, as we did back in week, it would have been week 3. So, and with this first part of the lecture and the second part, I would appreciate the feedback. If you are watching this, and if you feel that it helps you, or if it doesn't, suggestions on how I could maybe do it better, let me know. Just email me, and the email for me, you don't necessarily have to email your instructor who's Betty. I'm doing this for the entire region, so it's just not this one class. And email me at kveneski, my last name V as in Victor, ENESKEY at ivytech.edu, and I'd appreciate any feedback. So getting right in here to the final part of this chapter, and I've added a little piece onto the end of it to kind of make you aware of things that are being thrown out in the political world, which may or may not happen. It'd probably be a while if it did happen, called the fair tax or flat tax, different names that it goes by. And some people have a little bit of an incorrect idea about what it is, and I wanted to show the research that I've done on it and some good and bad aspects of it. Okay, first, W-2s. I thought it was kind of interesting here to note that 240 million of these are processed. Now, a lot of people get multiple W-2s. Some people don't get any. So that's 240 doesn't mean there's 240 million people working. That just, I have some clients come in here to get their taxes done, and I've had, one, I think had 7 W-2s for the year. Had a couple different jobs and then quit, and then had a couple different jobs. She had quite a bit going on. And 10% or so have some wrong information on it. That's a big penalty. Notice here, if you're caught and you have wrong information, that the company who prepares your W-2s, you're going to get a penalty of $50 per form. So the IRS needs the accurate information. If they don't have the accurate information, obviously your tax return could be off. So you have to get a W-2 if you had income, federal withholdings taken out, or Social Security taxes taken out. If you had one of these 2 taken out, you need to get a W-2. Your company should have sent you one. Okay, so generally you have withholdings, except if you wrote exempt on your W-4, which we talked about last week, filling out a W-4 form and showing that you have enough allowances or you don't expect to make enough money to have any money withheld, so you write exempt there in box, I think it was 7, maybe 6. The employer has to deliver it to you. And it's generally good that they want to keep backups. You want to keep backups for at least 4 years. You can get a look at a W-2. Most of us kind of have a good idea if we've probably received a couple of these over our life. But if you want to look at it, go ahead and go to the book there in Chapter 4, page 22 to 24, and it's going to show you a good overview of the W-2. I also have them in our class sessions for this week, an example of a blank W-2. Okay, so let's start going down through some of the different boxes. Box 1 is going to be your taxable wages, and that's the key word here, taxable, and this is, we'll put federal taxable wages, not just your pure gross income. Thus, if you made $40,000 but you had $3,000 taken out for medical premiums payment, that $3,000 isn't showing up. So therefore, in box 1, you would only have $37,000, not $40,000. And you see some of the other items that are going to go into box 1, and then some items that are not going to go into box 1. So all the things that we looked at the last week, basically, beginning of this lesson, which would have been last week, would not be included. Things like the flexible spending would be another example, or child care money being put back to pay for child care. Box 2, notice this is the amount that shows exactly how much federal withholdings you had taken out. And this is really the only box for federal purposes that you're going to get back as a refund. You don't get back boxes 3 and 5 that we'll talk, or actually boxes 4 and 6. These are money that was taken out for Social Security and Medicare, and you don't get them back. Box 2 is basically there to show how much you paid in, and then if you paid in too much, based on what you officially owe, then you get some of that money back. There are other ways to get some money back, especially like earned income credit is an example. Boxes 3 and 5. Boxes 3 and 5 are your Social Security taxable wages and your Medicare taxable wages. For most people, for a lot of people, boxes 1, 3, and 5 are always going to be the same. Now, there are times when boxes 1, 3, and 5 won't be the same. Especially boxes 1 will be different if you had retirement money put away. Because if you remember back to last week, retirement money put away is not taxed for federal purposes, for federal withholding. So you actually aren't going to see that amount show up in box 1. But you will see it show up in boxes 3 and 5. Boxes 3 and 5 are your FICA items. So if you had $40,000 and then $2,000 taken away for federal withholding, or for retirement, then your box 1 is going to show $38,000 of taxable income. However, boxes 3 and 5 will show $40,000 as taxable income because you don't get to use that as a deduction for those 2 items. And then the only difference between boxes 3 and 5, why they have those separated out, is for the Social Security cap. So once some employee hits $118,500 for this current year, they're no longer going to be taxed for Social Security. So the highest that box 3 could possibly be for this current year would be $118,500. Next year it'll be a little bit higher because of inflation. It goes up every year. So thus, it is possible that you could have a different amount for boxes 1, 3, and 5. That's if you made over $118,500 and you had retirement money withheld, would be an example of boxes 1, 3, and 5. Could all be different numbers. Okay, boxes 4 and 6 are kind of more informational, mainly for the most part. The only reason this comes into play is if you are up near the Social Security cap and or you have more income for Medicare purposes, you have over $200,000 or $250,000 if you're married, filing joint, then you have to start paying an additional tax. So that's where this could come into play, but mainly it's more just to make sure that you have the right amount taken out. Employee reported tips, box 7. Notice how these are included in box 1, and then the difference, why there's a big difference between box 1 and box 3, is explained for box 7 with the tips. Box 10, I didn't put it on here, but box 10 is your dependent care benefits that you have put away to use for dependent daycare. Box 12 has a whole bunch of codes that could possibly go in box 12. And you'll find these in the book. They have in that page number that I was referring back to. I think it's on the last one, page 24. There's a whole bunch of codes. The most common ones are the retirement codes, which would be D or E. D is 401k. I think E is more of a 403B. They're pretty much, for all intents and purposes, the same. And they're treated the same for taxation purposes. starting this year in 2015, employers are now going to have to put how much the employer paid into your medical premiums. And that's going to basically be that's going to basically help the IRS know if you had job coverage, if you had health coverage through your job. Because if you remember, it is required now, beginning actually last year in 2014, to have medical insurance. If you don't have medical insurance, then you have to pay a shared responsibility payment, otherwise known as a penalty. This, if the employer puts on there how much they've paid in, that's telling the IRS that you've had insurance through your work, and therefore you don't need to be penalized. Box 13, it's not used all that much, so I'm going to skip past that. Box 14, anything you ever see in box 14 is extra information. You don't have to put this on your return. You could put it on your return somewhere, but it's not going to actually be inputted into the tax program, whatever's in box 14. It's just extra information, maybe how much you put into your medical premiums, because then you could move that amount to Schedule A, how much you have paid in. Actually, I take that back. You wouldn't even do that, because if you had paid in money to your health insurance, well, that was already pre-taxed. Okay, boxes 15 through 20. That's going to be at the very bottom of your W-2. Going to be your state withholding information. So box 15 is the state. 16 shows how much your wages were in state wages. Almost always boxes 16 and box 1 are going to be the same, because usually the state goes by your federal wages. And then box 17 would be how much you had taken out for state income tax. 18 would be for county tax or city tax. How much wages you had. And box 19 is your county tax, how much money you had taken out for county. We're not going to really focus on that too much in this class. Just wanted to give you an idea of what those boxes are and what they're for. We'll look at it a little bit when we do a payroll project, just to make sure we have an understanding of how much money goes into state income withholdings. So just to give you an example here, and I told you if you want a blank blank W-2 on page 449 of the text, that's one of the problems, and we're not going to be using it, so we could easily use that to fill it in. What I'd like for you to do is pause the video in just a second, and then fill in this W-2 example and see if you get the right answers from what I'm going to discuss here in just a second. Knowing that we had full wages of $140,000, some money being put away into retirement, some into medical premiums. So go ahead and pause it at this time. Then when you get done, open up and I'll go through the answers. Okay, the answers for this one. Couple key things with the box 1 wages. You always start with your gross wages, and then you can subtract out your retirement money and subtract out any other cafeteria type plans that you have, including money put away into a medical premium. So we only have taxable wages of $131,000. Note, box 3 has to stop at the cap for Social Security. So that's why that one's only at $118,500. It would have originally been $136,000, but I can't go over the $118,500, so I have to stop. Where I got the $136,000 from is simply taking your wages, not doing anything for retirement, can't deduct it for Social Security and Medicare, but you can take off any medical premiums that you paid in. Okay, now let's look on to the final example, lecture example 6. And I want you to kind of do the same thing again and determine what's going to be in boxes. Actually, and I want you to go through box 12 this time. What's going to be in each of the boxes for this example. So go ahead and pause it. and then we'll go through this answer in just a few seconds. Okay, key things to look at with this one. 4,200, we have annual salary of 55,200, so that's going to be our base gross pay. It's going to be our starting point, and then knowing what can I deduct and what can I not. The 55,200, we get to take out our medical premiums. We get to take out our retirement money. Knowing that the employer matches it is not relevant for the W-2, so that's extra information. 1,500 going into the dependent flexible spending. Yep, we're not taxed on that. That's good. 2,500 going into the medical flexible spending. Take that off. Notice child support, that's not deductible, so that doesn't get factored in. And when you do the simple math here, 43,000 for box 1. Box 2, let me see what I did for this. All right. So what I had to do is look this up in the book. What I've given you, we've now determined what his total wages were taxable for the year, 43,000. No, I don't want to use the 55,200. That's his gross. I want to use what's taxable. And in the back of the book, they may have annual. I don't think they do. So that's why I went ahead and converted this. If he gets paid 43,000 taxable income over a year, we can simply divide that by 24 to see what our semi-monthly payment is. Because that's what he is. He's paid semi-monthly. So he actually has taxable income of $1,791. And given the information, let's see here, he's married with 3 exemptions. If you turn to the back of your book in the tables and you go to semi-monthly pay for somebody who is married, and then with 3 exemptions, look up this amount, $1,791. You're going to see that taken out of his check every week or every other week is $104. Looking at the tables. And then we need to multiply that back up to a yearly amount, because that's what the W-2 is a yearly total. 104 times 24 checks, he had taken out $24.96 for tax purposes. Box 3. Box 3 is exactly the same as box 1, except we'd have no retirement money. Box 4, pretty simple to do. Just take whatever box 3 was, multiply it by 6.2%. Box 5 is going to be identical to box 3 unless it goes over unless the Social Security was capped, and we weren't anywhere near that. So we simply take box 5 times 1.45%. Remember, as I discussed, box 10 is your dependent daycare, so they list here separately how much money you had put away for dependent daycare. And that's the reason. One of the reasons they do that is you can't double dip, which means on the 1040, there is an area there for, and we'll talk about this. We won't talk about it in this class. We talk about tax. That on the 1040, you have the option to take off some money, a credit, for child dependent care. But that's only available if you didn't use this pre-tax option. The pre-tax option is the better bet. With the credit you're only allowed a 20% credit of the amount that you paid, up to $3,000 per kid. So it's generally your best bet to go ahead and just have it taken out of your taxes up front. But this is saying you've already included $1,500 as pre-tax information. So if you spent over $1,500, the amount that you spent over you can use as part of your credit, but you can't use that first $1,500 that you used as a pre-tax. And then box 12 is showing how much the employer paid in, how much we paid in for retirement. And then it's now going to show in this code DD how much the employer paid in for medical premiums. Remember, the $4,000 is how much we paid in and why basically there's a difference between boxes 1 and 3. That's what code 12 is doing, is explaining that difference. Okay. Now, some other kind of miscellaneous forms. We're not going to spend very much time on any of them. But the W-3, this is something that the employer has to send in. You as the employee would never see this. This is just a basic summary of all the W-2 info for your business. So that W-3 total could be very, very high, especially if you have a large company. But for our purposes, if you had 4 employees and they all made $20,000, box 1, for the W-3, your box 1 would be $80,000. Most people will fill out via 941 form person. Not much more than I want you to know about that. Just simply it's a summation of all the W-2s for the company. 1099s, these are called informational returns. That's what the IRS calls them. They don't have money, really money taken out of them. There are a few that'll show money taken out. W-2 is kind of an informational form, I guess, as well. The 1099 is a very common item. The 1099 miscellaneous is what's given to independent contractors. If you earn over $600, you're going to be given from a company. If you earn over $600, you're going to be given a 1099 miscellaneous that says you have earned this much money. We didn't take any taxes out or pay any on your behalf. Therefore, it's going to be your responsibility to report this money and then pay your Social Security, Medicare, and federal taxes when you do your 1040. So if you do a lot of small jobs, nothing really would ever be reported to the IRS, especially if you did a lot of jobs for individuals, because individuals do not have to send out a 1099 miscellaneous. Only companies have that responsibility. So it doesn't matter if you did even a big job for an individual and they paid you $4,000, they don't have to send you a 1099 miscellaneous, so it's on you to report that income. 1099 dividend, div or interest, INT, pretty much self-explanatory. It's going to tell you how much dividends you have earned for the year or interest, how much you have earned. It's going to break them up too. When we talk more about this in tax class, we're not going to get into that here. 1099-R is going to be your retirement money, whatever form it came in. It's going to pretty much show up here. One I don't have listed on here, a 1099 SSA, which is your Social Security statement. That's going to show how much money you got in Social Security and how much was taken out for any Medicare items, any additional items that you had for Medicare. 1099-T is the tuition form. It shows how much you were either paid or were billed. It's not a good form. Hopefully that will be revised in the near future. I've had discussions with the IRS about this, and they know that it's not good, at least the individual I talked with, and they hope that that will be adjusted soon. We can't, the ones that Ivytech send out, we can't use them. We have to actually go in and look at each student's bill and see how much they were billed and when they were billed, just because this form is no good. File 1096, you have to file 1096 for every group of the 1099. So if you send out 6 1099 miscellaneouses, you'll have to fill out one 1096 as a summary of that miscellaneous. And then you'd have to fill one out for each 1099-R you had. Okay, I want you to be familiar with the different names and what they're for. That's what I basically want to get out of this for this class. State income tax. We're not going to talk a whole lot about this. This is more of a federal class, but it is good to know a little bit about state income tax, and that most states do collect an income tax. And the key here is you are taxed in the state where you did your service, which is very critical. You could easily live in Texas. Texas, as you'll see in this next little item here, is one of 9 states that does not have a state income tax. Indiana has one. It's relatively small. It's 3.4%, but that adds up. States here don't have any taxes, Texas being one of them. You could easily live in Texas, have your home in Texas, but work outside of Texas in a very, not a common, but one that I like to use as an example is if you're a professional sports player, you have duties around the nation. You may have 6 or 7 games in California, same in Florida, maybe 2 or 3 games in Indiana. You're going to have to pay income tax in each one of those states that you performed your service, even though you lived in a state that has no income tax. You're still going to be filling out possibly up to 41 different state income taxes. And that's usually where somebody would want to hire an accountant. Indiana does have income tax, and we have to file what's called the IT-40. You can easily, I put the link here if you wanted to go look at it, see what's all involved. And then I give us this little example. It's kind of an exception to this rule. Your services are taxed on where they're performed. Almost always. There is what's called a reciprocal agreement, where with some states, Indiana has it with states like Michigan, Kentucky, Ohio, Pennsylvania, Wisconsin being another, where if somebody, say, lives in Evansville but works across the border in Kentucky, the person will tax their income at the Indiana level and not have to do an Indiana and a Kentucky form, because that just gets to be a burden. However, we no longer have an agreement with Illinois, and there are reasons, and I get into this in class. But basically, if someone lives in Gary but works in Illinois, they're going to have to fill out both a Indiana return, a resident return, and an Illinois non-resident return, because they don't live there, but they work in Illinois, in Chicago. Illinois and Indiana don't have a reciprocal agreement, basically because of Chicago. And I tell you about the reciprocal agreement here. We, again, have one with most of the states surrounding us except Illinois. And then I give you a little, it's kind of a good, neat little read here about professional athletes. I think you might get something out of it. You might want to read it. I'm not going to spend the time right now. Here are the reciprocal agreements we have and ones we don't with Illinois as of the end of 1998. County taxes, we in Indiana do have to pay a county tax. The big difference between county and state is county is taxed where you live, not where you work. So for example, I live in Madison County, but my primary employment is through Delaware County at the Muncie campus. However, I'm taxed at the Madison County rate. Then they do that, the county reasons is because basically where you live is probably where you're going to spend most of your time and where you're going to want the services. You're going to need 911 service or street repairs, the local government, whatever else needs to be paid. That's why you're going to pay where you live, not necessarily where you work. Because we could have a lot of people work in Indianapolis and then Anderson wouldn't get very much money. This is simply just to let you know, this is just more of an FYI for Indiana purposes, what you have to fill out to show how much money you have collected. Kind of like a 941. All right, the last thing I wanted to mention is what's called the fair tax option. Taxes can be very confusing, very gray in some areas, and what has been going around, and it's been going around for quite a while now, but it's starting to pick up a little bit more traction. And I have begun to mention it now in my notes, just to give you an idea. What is the fair tax? Okay, so basically the fair tax is like having a national sales tax. Right now in Indiana we pay 7% sales tax, and that is considered a flat tax. A flat tax is a sales tax. Everybody pays the same 7%. Generally, when I start talking about flat tax, a lot of people get all up in arms. They don't think it's fair because low-income people will pay the same as a high income, and that's true. But yet, I don't really ever hear people saying much about the sales tax that we have currently in Indiana. So I don't know if people really understand that we already have flat tax. Some of the facts with this flat tax. One group, now they could easily debate this and go back and forth, but one group has said it would be pretty even if we had a state or a national sales tax of 30%. Sounds pretty high, and it is high. But it works out to be the same as if you were paying a 23% tax. Now, most of us who make, I would say, less than, at least 60,000. If you make less than 60,000, you don't quite pay 23% in taxes, especially if you make under 40, 30,000. The only taxes you pay are your Social Security and Medicare, which would be 7.65% total. 7.65 plus 10 is probably where a lot of people in the 40,000 range are. 60,000, you may be a little closer to this, which is kind of the breaking point. So what the rule says is paying 30% is exactly the same as having 23% taken out of your check. Sound confusing? Yeah, it can be. But let me give you the explanation of how that works. Let's say you wanted to go to the store and buy a jacket, and the jacket is $77. Well, you could pay for it in one of two ways. You could say, okay, let's do it the normal way, and let's say I have a 23% total tax taken out of my check. Social Security, Medicare, and federal income tax. So you take the 100 you earned minus the 23 that they took out of your check, you're left with $77, just enough to buy the shirt or the jacket. Option two, if you decide, I want to do the fair tax. So instead of having taxes taken up front, you get the entire $100 right now. Okay, so you have $100 in your pocket. You go and buy this shirt that costs $77. Then they tack on 30%. 30% of 77 comes out to be $23. So 77 plus 23 is $100. You had just enough again to pay for the jacket. So it came out even. Both ways, you got the jacket and you had no money left over. So everyone, with this fair tax, the proposal is, since you have such a high tax of 30%, and it would be high for especially low-income people who normally don't pay this net rate of 23, what they're saying is you would get back a monthly stipend, basically. You're going to get free money to pay this tax to help offset it, basically. And you can go to this website, and if I open it up, then you're not going to be able to see it, but simply just open it up, put it in a browser, and it's going to show you a lot of the, it's going to show you on the first couple pages just how much money you would get back based on your household size and if you're married or single. So I thought it's a pretty good little overview of what you're going to get back in a year or monthly. You would typically get a monthly check or a direct deposit showing that here's some extra money to help you offset the sales tax, which is good, especially for low income. So what the fair tax would do is it removes basically everything we do now. There would be no federal income tax, no Social Security tax, no Medicare tax, so no FICA taxes any. There would be no corporate tax. April 15th would go away. There would be no tax deadline anymore to fill out. All of these taxes gone. The sales tax, this fair tax, would replace all of it. So I put a little recap here. Federal withholding and FICA make up about federal withholding 5%, FICA 7.65. If you have 40,000, that's kind of what I was saying before with no kids. So their reasoning is, with this money you get back, you should be staying pretty even with as what you were with our pay-as-you-go system now, the payroll tax. And so my question then is, what they're saying to me fluff, or does it really pan out? And I kind of got two different answers. I made up in my head an example, and then I've tested it. I've tested it using the old way, and then I tested it using the proposed way. And let's see what happens here. Here's my example. Family of 4, so mom and dad and then 2 kids living at home. Total income of $50,000 between everybody. And one thing that I wanted to mention, I don't know. Okay, here it was. This fair tax would be paid on all new goods, all new items that you purchase, and services. Right now in Indiana, we don't pay tax on services. So if you went to an accountant and had something done, they're going to charge you $100 and you're going to pay $100, not with sales tax. That would not be the case then if this fair tax would ever go through. You're going to be taxed on new goods and services. But the good thing is, for lower income, you can buy used goods and it's not taxed. So everything is taxed one time and then it's done. That item is never taxed again. Where now in Indiana, you're taxed on 7% of whatever you buy, new or used. So the same item could be taxed multiple times, which I don't like. If you buy a used car, the person who bought it first pays tax on it, then you have to pay tax on it when you buy it used. There's just so much tax going around. So out of the $50,000, $35,000 was spent on services or new goods. The remaining was spent to pay down debt, to pay for items used item basically. So let's break it down. With our current income tax, and I went in and pulled up a 1040, put in some of this basic information, 50,000 income with 2 kids, that included, possibly having any earned income credit or any other credits that may go along with it. And what it calculated is, I estimated that I paid in $3,000 during the year. I got back $2,634. So in net, I really only paid $366 in federal income tax, which was a pretty low amount. When you add up my federal income plus Social Security plus Medicare, I paid in $41.91 total in taxes for the year. So therefore, I had a net pay of $45,800. Using the fair tax, if my $35,000 was correct and I only paid $35,000 on new goods and services, I would pay taxes at $10,500. But I get a rebate. If you go back to that chart that I had showed you the link to, I get a rebate based on my family size of $7,328. Therefore, in total tax, I'm only paying $31.72 compared to total tax of $41.91. So I'm basically saving almost $1,000 in taxes. And this way, the fair tax is a good thing. And the key is, how much are you spending right here? How much are you spending on taxable items? If you bump this up to $45,000, then you're not really saving money. So just quickly example, $45,000 at 30% bumps this number up to $13,000. $13,500. 13,000 minus the 7 would give us about a total tax of 6,000. Then the total, you're paying more in tax. So how much are you going to spend on new goods or services? And that's where it's going to come down to being if it's a fair thing or not. So I put that if you spend 35,000 or less, this tax is definitely going to be a good thing for you if you're in that bracket. Now my second example looks at somebody with a lot less income, and they even get some of their income tax-free through child support. So this individual only has 14,000 in earned income. She lives on 24,000, so that helps her out. I guess she gets 10,000 free money. And of that 24,000, 22 of it is spent on new goods and services. So with her current tax, with the current rate as it is, she would actually get a huge refund instead of paying money on her 1040. She would have paid in nothing because she makes so low she could call herself exempt basically. And she would be getting back $7,110 because of earned income credit. Earned income credit with having 2 kids and being in the prime earning wages. Basically, she's going to meet a couple of the criteria, but as long as she has met the criteria and is in that earned income credit range, she's getting back quite a bit of money, $7,110. Again, I did this in a tax program. And then reduce that by the amount of Social Security and Medicare she had to pay in. She's really getting paid just over $6,000, which bumps her 24,000 up to 30,000 in a year net pay. Fair tax option. She paid 22,000 at the register, so that totaled out to be 6,600 in taxes. She gets back $4,600 in taxes as a rebate. Thus, she's paying just under $2,000. Just paying under $2,000 and getting back just over $6,000. That's a big difference. $8,000 in difference. Right now, I can't figure out if I'm going wrong anywhere. I've written to the people who have put up this website. I tried to email them, but they don't really have an email address. I'll probably end up sending a letter here soon because I would really like to know. They keep saying how it's a good thing for the low income, but right now I'm not seeing it for the very, very low income and the poverty level. So hopefully I'll get an answer back, and sometime soon I'll be able to hopefully update this and say, well, either I was right and their item isn't as good as they proposed, or I've miscalculated somewhere, or I'm not understanding something with the rebate system, because the rebate is kind of low compared to how much she's going to be spending in taxes. All right, I'm going to stop this at this point. I will then create a second video at a little bit here at a different time with a different recording for just help with going through the combined examples with the payroll register in 941.